Hello, everyone. Welcome to video 4 of chapter 9. I wanted to start this video with a quick elaboration to something that I said in the moving expenses video earlier in this chapter. So sharing the screen. When I constructed this sort of more detailed example of moving expenses, I just missed out meals for the temporary living. So when I'm moving, I can stay close to my new home or my old home. Once I've made my selection and I'm staying there for a few weeks or a few days waiting for, my new house to be ready to move in, um, the expense or the lodging can be deducted up to 15 days. So I mentioned about trying to find a daily rate. So if the total fees were $2,400 and then we stayed for 21 days, that's 114 per day times 15 days is 1714. So that's what we picked. Sometimes, usually hotels will give you a daily rate. So if your hotel fee is $120 per night, you can just take that 120 times the number of days you stayed up to 15. What I want to elaborate on is meals. While you're staying in that hotel for up to 15 days, you can also deduct the meals that you paid for. Now you can keep the receipts and deduct the actual meals, but the simplified method we mentioned before during travel can apply to our temporary living. So to remind you, that's $23 per meal, 3 meals per day. So that can come out to $69 per day, and that's available for every person in your family. So in our example, we had a family of 5. So 5 people, $69 daily allowance for 15 days. We could add another $5,000 to our total moving expenses. So I wanted to make sure I fixed that missed item, and now we can move forward with the lectures for today. Where we left off in the slides discusses disability supports. This comes right after childcare expenses. This topic is very low priority in this course. I can't think of any questions we ask you related to disability supports. So just to be safe, feel free to give this a quick read through in your textbook. But for our videos, I'm going to just jump past these to the next subject, which is pension income splitting. In tax one, we mentioned that the best way to avoid or save taxes is to split our income. Um, if I have $100,000, that income will be in a higher marginal tax bracket than the lowest marginal tax bracket. So the way the Canadian progressive tax work is the higher your income, the higher your marginal tax rate is because you move through those marginal brackets. So if I can split that $100,000 of income to 50 and give that 50,000 to my spouse who doesn't have any other income, now we have 2 people at $50,000, both paying tax in the lowest tax bracket, and that pays combined less tax than one person paying 100,000 in those first two brackets. So income splitting is just such an effective way to save taxes, and splitting income's one of the few ways that you can easily and legally do this. Someone who's earning pension is likely retired. They're likely on the older side, and so their income's fixed by that pension. Their opportunities for additional income are possibly limited, so to help them out, the CRA allows for pension income to be split up to 50%. Now, if I retire and I'm earning retirement income, I'm earning my pension income, but I'm not ready to be done working, I can go get another job. That job will be employment income, and I'll have that in addition to the pension income I'm collecting. But always remember that for pension splitting, only the pension income can be split. So we can transfer up to 50% of the pension income. When we split the income, the person who receives the money is called the transferee. They are going to add to their tax return every dollar that I subtract from the pensioner's deduction. So if the pension split is $20,000, my income goes down 20, their income goes up 20. So every dollar that comes down, their income must go up, but this creates additional opportunities. I have pension credit on my tax return because I'm earning pension income. My partner, who didn't have any income before, wouldn't have had the pension credit. But now that I've taken some pension income and popped it onto their return, now they're eligible for the pension credit. So not only did we save taxes by splitting our income, we've also duplicated credits, saving us more money. Anytime you adjust your income, you're going to adjust tax results that rely on your net income as well. If I'm receiving pension income, I'm probably old enough to also be receiving old age security, OAS. But the rules of old age security is if my overall income is too high, I have to pay back a portion of that OAS. So if my income with my pension income, if my income's too high, so I have a clawback, splitting that pension income to my spouse might mean I'm saving taxes, duplicating credits, and saving on that OAS clawback. Changing the net income might also affect credits that are coming to us. Medical expense has a 3% of net income threshold. So you can only get a credit for expenses over that threshold amount. So if I'm reducing my overall income, that's reducing that threshold, and I might have more medical expense available to me. The spousal and age amount, my spouse wasn't earning any income, so those credits were coming to me. By applying the pension income to their tax return, now they're using up the credits. So one of the things that affect is I might be missing out on spousal and age credits that I would otherwise be getting. So this movement of net income, the changes in credits, what's available, what's not, can have somewhat complicated consequences on the various tax returns. So tax softwares have an optimization option, whereas they will check the result of transferring 1% of pension, 2% of pension, all the way up to 50%, and coming out with the perfect transfer amount that gives you the best result. Because credits and all these things are being adjusted for every dollar that's changed, sometimes it's not the best thing to transfer 50%. Maybe it might be best to transfer 20, 25, maybe just 8% of the pension income. So the optimization will check all of those potential options and will let you know what's coming out as the best consequence. So it might say, here, transfer 32%. That gets you the biggest refund between you and your spouse. So to go for an exercise, exercise 9-4 for pension income splitting. Joanna Sparks lives with her spouse, John. They're both 67 years of age. In 2024, Joanna received $8,500 in OAS payments, and she also received $85,000 of pension income from a retirement savings account that was sponsored by her former employer. She has not yet applied for CPP. John's only income for 2024 was his OAS payments of $8,500. Neither Joanna nor John have any personal income credits other than the basic personal amount, age credit, spousal credit, and potential pension income credit. So Joanna wants to know how much can they save in federal income tax as a result of using the optimum use of their pension income splitting for 2024. So what's the result without the pension split? What's the result with? So we will start before the split. We're not splitting income, it's all in Joanna's name. John's income is only the OAS, and that 8,500 is not enough to get above his basic personal amount, that basic credit. So we know John's not going to owe any taxes. So all the tax is going to be in Joanna's hands. So that's where we will focus our attention. The 85,000 that Joanna earned plus from the pension plus the OAS that she received, her total income was 93,500, but that's over the OAS threshold, so she has to pay back 15% of every dollar over that amount. So at 93.5, she will pay back $375. So her net income is 93,125. So we have this income amount. That's enough that she will pass the first tax bracket and will be within the second one. So at the first tax bracket, that first 55,000, she will pay taxes of 8,380. And then for the next amount of money up to 93, she will pay an additional 7,638. So the gross taxes before credit is just over $16,000. The credit she will receive is the basic personal amount plus the spousal amount for the unused portion of John's credits. That says 87, that should be 8,500. So John used some of his credits and only what's left will go to Joanna. We have Joanna's age amount. So she gets 87.90, but that will also be reduced by her income over 44,000. So 1470. She gets the pension credit, and she's also going to get the unused age credit from John. John doesn't have any taxes owing, so we get that credit as well. So Joanna has a sizable amount of tax credits. That will save her $5,276. So she'll owe that 10. She has that plus the OAS clawback she has to pay. And so 11,118 is the total taxes Joanna and John will have to pay. If we split the pension income, can we save them some money? Given that Joanna and John both collected the same amount of OAS, and once the pension income is split at 50%, they're both now getting half of it, 42,500. So they have the same income. There's no OAS clawback anymore, so they're both dealing with a taxable income of 51,000. So their tax return's going to be the same. So we can look at the credits for one, and we can just double that outcome to get an idea of them combined. At 51,000, now the taxes are only in that first bracket. So gross taxes is just 7,650. Joanne is no longer going to get those spousal transfers or the age amount because John's now using them all up. So 15,705 for the basic personal. Our age credit is much higher because we no longer have that high income, removing it or taking it back down. Pension income of $2,000. So Joanna's tax return is going to be saving $3,824 because of those credits. So gross tax 7650, saving 3826. The federal tax payable is 3,826. Since their income's the same, both of them will be paying this amount. Before, the tax payable was only on Joanna's. So 3,800 times 2 is $7,600. So before combined, they were paying a little over 11,000. Now they're only paying a little over 7,600. So they saved almost $3,500. They saved $3,466 because of their ability to split their pension income. So this pension income split has a large effect. It's great getting that money back. After pension income splitting, there's also a modification to income if you're paying child and spousal support, specifically spousal support. Child support payments are basically what isn't identified in agreement or court order as spousal common law support. So if I'm in a relationship and that relationship has a breakdown and I separate or divorce, that separation agreement might outline some support payments that I have to pay. It's something we've agreed to. It has to identify how much of the payment is child support, how much of it is spousal support, because if it says nothing, it's going to be assumed that it's all spousal support. So child support amount is what isn't identified as spousal common law support. So by declaring that a certain portion of those payments are spousal, the rest of it must be child support. Because child support payments, if my children live with me, if our relationship is together, I have to pay to take care of my kids. The fact that we're apart, that child support is to pay to take care of the kids. It's amounts that would have to be paid to, if my children were living with me, to support their expenses, to support their needs. So because it's a personal benefit to me to make sure that my children are cared for, child support is not deducted from my income. That's an expense for my life to make sure my children are cared. Child support is not taxable to the recipient. So I'm taking money and giving it to my ex-partner. They are receiving it, but it's not income to them. It is an expense reimbursement for the care of my children. Any amount not designated as spousal support is child support. So to have a deduction and inclusion, if it's not child support, Spousal support is I'm taking some of my money, I'm giving it to my ex-partner. They are going to use it to sort of maintain lifestyle, pay bills. They are the beneficiary, no longer my children, but my ex-spouse. So because the benefit is no longer personal to me, it's now personal to them. I get to deduct it from my income and they will add it to theirs in similar way of that pension income. For every dollar I give them or for every dollar I subtract, that's a dollar that's added to theirs. But it has to be payable or receivable on a periodic basis, paid for maintenance of recipient, children of recipient or both. This is just payments in general. Recipient has discretionary use of payment. So it's not here's $400 for insurance, because if it's for a specific use, I'm reimbursing that expense. It's not for discretionary use for their personal benefit. Where recipient is spouse or former spouse, parties are living, pardon me, separate and apart. This is to ensure that the relationship has a separation. It's to keep people from who are still living together from just saying that they're no longer in a relationship, signing a separation agreement, and are now using it to modify their tax return between the both of them. It's a rule in place to ensure that these support payments are to support their lifestyle separate from me, not to create a tax arrangement to split income. And it must be pursuant to a formal agreement or court order. The separation agreement, the court order, is what legally identifies these payments as child or spousal support. Without a periodic basis, I can't just take some money and say, here you go, here's $10,000 and do the subtraction. It has to show that it's a periodic basis, that it's meant to be a continuous payment to support their lifestyle. If support payment, then include in recipient's income less what is considered child support. So if I pay $1,000 a month and I say, okay, $800 of it is for spousal support, then the difference, the $200 must be for child support, right? So they will add to their income the $1,000 minus that 200 child support. I will subtract $800, the spousal support, they will add $800 because that's the difference between the full amount received minus the child support. And that's important for, actually, we'll go on the next one. That's important for knowing if I'm not making my full payments. If I'm not paying the full amount, it is assumed child support is getting paid first. So it's important to know how much of a payment is child support and how much has actually physically been paid. Lump sum payments are commonly not considered part of the support unless they're for making up overdue payments that haven't been paid yet. So if I didn't pay for 6 months, yes, I paid it as a lump sum, but this lump sum was representative. It's catching up those missed payments. If insufficient payments, first payments are considered child support rather than spousal. Payments for spouse to third parties can be deductible and taxable. So it's considered that that money is being received by my spouse and they're adding it to their income. But if the spouse says, no, I've had my car fixed, just pay the money to the mechanic, I'm still paying that money on their behalf. They're still benefiting from it. It's for their car. So even though I paid to a third party, it's still considered I've given them the money and then they paid the mechanic. Payers not permitted to claim legal expenses. Recipient is allowed to certain expenses enforcing collections. So they don't want people who have to pay child support from just keeping legal battles going in order to deduct from their support payments. So they don't get to claim the legal expenses against their income. But if someone is forced to take someone to court in order to claim the support payments, then those can be deducted because those expenses directly relate to an income inclusion. By reducing our income, that's going to affect our RSP contributions. We will discuss more of that in the next chapter. The recipient of child support can claim credit for eligible dependent. Individual is not eligible for credit for spouse or eligible dependent if deducting support payments. So the claim is, well, I'm paying child support, I'm paying for the child, I should get the tax credits. It's not based on the dollars, it's based on who does the child live with. you need to have some custody arrangement that you are physically caring for the child in order to claim those eligible dependent expenses. So if the children live with my ex-partner, all of my payments to them are in support of the child, but because the child lives with them, they get the credit as well. So that question is just in the next one. So on June 15th, Sandra and Jerry Groom signed a separation agreement that calls for Jerry to have custody of their 5 children and for Sandra to pay monthly support of $4,000. So $4,000 is being spent per month beginning on July 1st. So our tax year ends December 31st. July to December is 6 months. So we expect 6 payments of $4,000. Of the $4,000, $1,500 is for child support and $2,500 is for spousal support. In 2024, Sandra paid the required support payments for 3 months only, a total of $12,000. So Sandra was supposed to pay $24,000, 6 months of $4,000, but she only paid $12,000. How do we treat this? How do we ensure or figure out how much can Sandra deduct from her income? Well, where we start is figuring out how much child support payments were supposed to be paid. So child support was $1,500 a month, and there was supposed to be 6 payments. So $9,000 was expected to be paid for child support. Another $15,000 was supposed to be paid for spousal, but we only received 12. So what we do is we check child support first. Child support was 9. We'll take that. Only what's left is considered spousal support. So $3,000 was paid for spousal support. So Sandra will deduct the $3,000 from income. Jerry will add $3,000 to his income, but because the children stay with him, he is also capable of claiming that eligible dependent credit. I would normally this is where I would stop the video, but I want to have this quick discussion for annuities because next video is probably also going to be a bit longer talking about registered savings accounts. An annuity is an amount that I pay into, I give money, and there's an agreement that a certain amount of money will come back to me every year for a certain number of years. So I put $20,000 into an annuity and they will pay me $1,500 for 20 years. So annuities are fixed payments for a set amount of time. So annuities are either payments, combined interest and return of capital for a specified period or the life of the annuitant. So the life of an annuitant is it's going to go on forever until you pass away, but that's still usually there's an expected set amount of days. Um, if an annuity that goes on forever is actually called a perpetuity. So when we discuss annuities, we will usually give you, or we will almost always give you a set number of years. This annuity is for 3 years, 5 years, 10. So we like to have the specified period because it's going to affect how we consider the income. So Income Tax Act 56, the part that talks about income inclusions, requires the inclusion of all annuity payments not otherwise required to be included. The Section 56 does not include payments from tax deferred plans, RSP, as these are otherwise included under Income Tax Act provisions. So annuity payments, when they come back to you, are set up in 2 parts. There's a taxable and non-taxable portion. I gave $20,000 into the annuity. So when it makes its payment back, a part of that is repaying that principal amount, and another part of that is an interest earned on it. So we have to figure out the taxable, the interest portion, from the non-taxable. So what we'll do is we take the cost of the annuity and we compare it to the total payments we expect to receive. So purchase with after-tax funds a 10-year annuity of $16,055 per year. The cost was $10,000. So I bought a 10-year annuity for $100,000. So my cost was about $10,000 per year. So we'll take the $16,000 I will receive, subtract the cost for that year. The difference of $6,000 is going to be included in income. So that's what they mean by all annuity payments not otherwise required to be included, is kind of saying, talking about the annuity payment has to pay back my original amount. Anything on top of that is extra. It's extra income. So I received $16,000. I paid $10,000 for it. So I have income of $6,055. There's not a set example exercise for it, but if I had an annuity, let's say I purchased an annuity for 95,222, number of years is 3. My annual payments are going to be 38,596. So I want to know my total payments. 38,596 times 3 is $115,788. That's my total payments. It cost me 95,222, so I have $20,000, $20,566 of total income. I paid 95,000, I'm getting 115. That difference is income. So that income is going to be split over the years of the payments. So divided by the 3 years is 6,855. So that's our answer down here. We're kind of jumping to it. But what's happening is I'm basically taking the total income for the annuity and splitting it up on a per year basis. How does this work? If I buy the annuity in my RRSP, that RRSP, that registered savings plan, is pre-tax. I save taxes. I didn't have to pay tax on that paid amount. So when I receive that principal back, I still have to pay taxes on it. And then the additional income, I still have to pay taxes on it. So that full annuity payment, if I buy an annuity through my retirement account, that full payment when it comes to me will be taxable. If it's from after-tax funds, which means it's not through a registered plan, I've paid my taxes. I took the remaining funds. I bought an annuity. The full payment will get added to income, but I will get to deduct that cost portion of the annuity. So the deduction equals my annual payment times that percentage of the total payment that was based on purchase price. So 95,222 divided by my total payments received of 788, 82.23, about 82% of my payments received are principal portion. So I received a payment of 38,596. It's expected that of that 38,000, 31,740 was principal portion. It's a non-taxable amount. So I get to deduct that amount from the income received, leaving me with that 6,855. That's the 1 year's worth of income from my annuity. So I wanted to emphasize that we are getting close to 30 minutes, so I want to finish this video now. When we come back, I will give more details into registered savings plans, and we can continue more on education and I think disability savings plans and tax-free savings account. So thank you for your time. I'll see you in the next video.